The easiest method to create generational wealth is through investing. And today, I'll categorize the types of investors you can be in order to become financially free. The thing is, most beginners lose money because they pick a strategy that completely clashes with their personality. By the end of the video, you'll know exactly which financial identity resonates with your personality. First of all, you have to start investing. No matter who you are, how old you are, even if it's a pound, a dollar, a euro, I don't want to hear excuses like it's too complicated or I don't understand economics. You don't need to. Note that this is not financial advice, but the first step is knowing what type of investor you want to be. I would categorize these into four main types: the value investor, the growth investor, the income investor, and the index investor. People choose to be different types of investors for different reasons, and it's completely personal to you. But I will say the type of investor you are will probably change as you become a better investor. If you're a complete beginner, which is totally okay, I would say start as an index investor as it's kind of a black box and you can follow a simple approach without knowing much and still be financially free. It would be a huge advantage to understand risk, where your money goes, the benefits, and so on. But generally, you don't need to know as much about investing to be an index investor. The first type of investor we have is the index investor, and the bread and butter of index investing is the S&P 500. You might have heard of it. It's just a collection of the 500 best performing stocks in the American market. If you invest in an index fund that tracks the S&P 500, your money is split across 500 different companies, not evenly, but based on percentage weightings that's assigned to each stock based on something called market cap. You might not have heard of the S&P 500 or you might not completely understand it, so let me spare you the boring details and let's gamify it. Imagine you're betting on a team in the Champions League. Let's say Real Madrid. Real Madrid, the team, is the S&P 500, and the collection of players on Real Madrid, in this case, are the stocks. This isn't really a one-to-one translation, but you could bet, for example, since you believe Real Madrid have such good players, they're going to win the Champions League. This could translate into investing by saying that the S&P 500 has such good stocks in it, you believe it'll make a profit over the next decade, for example. And quickly for my basketball people, it would be like saying I'm betting on the Lakers to win the championship because they got Bron, Luca, and Bronny. This pretty much encapsulates the basics of index investing, betting on the best team to win. And in the case of the S&P 500, you're betting on Team America to win. There are endless amounts of indexes such as the S&P 500, Nasdaq 100, Dow Jones, FTSE 100. Picking which indexes you want to invest in is completely dependent on you and personal preference, but you're looking for what you believe in. The good thing about being an index investor is that your gains are consistent and pretty much guaranteed in the long term. In fact, if you invested in the highest point of the dot-com bubble, you would still be in the green right now. The key to index investing is investing as much as possible in the longest amount of time possible. With this approach, your chance to actually lose money goes as close to zero as possible. But as with anything in life, there's a trade-off. With being an index investor, it's boring as hell. Like, you just invest. That's it. No research, no stock picking, none of the quote unquote fun stuff. You'll understand why I call it boring when we get to the other types of investors, but its gains are also limited. And what I mean by that is crazy runs like Palantir in 2025 won't be as impactful to your gains compared to if you were just invested in the individual stock. And this is because of weightings, like I mentioned before. If I invested $1,000 into Palantir at the start of 2025 till its peak, I would be up 175%. And $1,755 compared to if I invested that same $1,000 at the same time into the S&P 500, I would only be up 16% and $167. Do you note that this also works on the reverse side and your losses won't be as significant with index investing? So just imagine there was a negative in front of those numbers. The next type of investor is the growth investor. The goal of the growth investor is in its name: as much growth as possible at a fast rate. And don't get this twisted with day trading or swing trading. A fast rate for investors is between 1 and 5 years. This type of investing requires a bit more XP, so I'll give some of you level 1 crooks quest at the end of the video to get your XP up. The way a growth investor approaches investing is by investing in companies with high growth potential. There are multiple methods to find companies that fit the description, like technical analysis, fundamental analysis, or even just pure vibes. I would personally say the best approach is fundamental analysis with a sprinkle of vibes. And I don't mean gut instinct or gambling with stocks. Within fundamental analysis, there's quantitative analysis and qualitative analysis. Qualitative analysis is as subjective as it gets with investing. Here, you're evaluating how big you think a moat is, the leadership of companies, its long term thesis, and all of this needs some sort of judgment, which will be subjective to an extent. That's where vibes come into play. If the CEO is a psychopath, it's probably not a good idea to trust him or her with your money. The best part about being a growth investor is the fact that you're potentially exposed to such high returns, but on the flip side, you're exposed to more risks. So it's up to you to decide. This could be a pro or a con depending on who you are, but being a growth investor takes so much time and effort and also interest. If you're not interested in researching different companies in a range of different industries and just learning about companies in general, you will not enjoy being a growth investor. So don't try force it and be something you're not. One point to also make with being a growth investor is to use your unfair advantage. And what I mean by this is if you're an expert in a certain field, you have knowledge in it that is not readily accessible to others. And you know what to look for in a company in your industry. So use it. Say, for example, my sector is tech. So I understand the capabilities of certain AIs. And I know better than to feed into the hype in certain cases. Some examples of recent growth stocks that have been good picks are Google, ASML, AMD, and Nvidia, to name a few. The next type of investor is the value investor. I personally think that there's a lot of overlap with value and growth investors, and their philosophies can be used in confluence. Value investing is being able to recognize and invest in companies which have amazing fundamentals at a discount. The most important thing is being able to spot these types of opportunities. They aren't once in a lifetime, but they're not going to happen every month. The concept sounds straightforward, but it's a lot harder in practice than it sounds. If you want to be a good value investor, you for real need that dog in you. You're going to be going up against the crowd, and that takes a lot of grit and a lot of self belief. One thing you have to understand about investors is they're going to follow the general consensus. That's just how humans are. Like, we have to accept it. An example of a good pick for value investors was Google in 2025. With the hype of new LLMs and chatbots at the time, such as ChatGPT, people thought Google would die off, specifically the search part of Google. So they decided to sell it off and kill the whole sentiment behind it. The lawsuit about Google being a monopoly didn't help either. But a small minority of people saw through this cap and realized that Google was still positioned to be a leader in tech like it's always been. And they were rewarded, let's just say that. Value investing and growth investing together is my personal favorite type of investing. It requires even more time than just simply value investing or simply growth investing. So be prepared with what comes with that. The final type of investor is the income investor, aka the old man. The goal of this type of investor is passive income, which is achieved through something called dividends. It's pretty much just a percentage of profit that's paid out to investors as a kind of thank you. It sounds pretty good in practice, and it actually is depending on the circumstance. But if you don't have an immense amount of capital, plus you have a lot of time, it's not the route I would recommend. The purpose of income investing is more maintenance and preservation, which is why it should be in later stages of your financial life. Let's say you own shares in one of the best dividend companies in the world, legal in general. If you paid for one share, which would cost you around £2.80 at the time of recording, you would be getting back 28p twice a year. Compared to if you owned 1,000 shares worth £2,832, you would be getting back £218 twice a year. As you can see, it's not that appealing when you don't have as much capital. So I'll let you decide what type of investor you want to be based on who you are, because only you can do that for you. I will say that there is a lot more to investing than this simple summary, especially with researching companies, maintaining investments, and actually understanding them. As with most things in life, it's better to just get started. So your main quest is to start today. Side quest is to join the Discord and say you've started. Ask any questions along your journey to generational wealth and financial freedom. No one is going to want it more than you. And you're the only one that can do it for yourself. So why not show yourself some love?